So we are going to go ahead and get started. Thank you for joining us today for this important webinar about learning the pros and cons in structuring a business. My name is Elizabeth Aloni. I'm with Schneps Media. Schneps Media is the largest local media company in the New York metro area. We publish over 80 newspapers, magazines, websites, webinars, podcasts, and events throughout all of the boroughs, Long Island, the East End, Philadelphia, and now Palm Beach, Florida. And today we are very lucky to have two experts with us who can talk about when you're looking to open a business and understanding the tax structures. So they're going to be able to walk us through it and leave you better than you were when you came. So first, let me introduce to you John Donofrio. John is the president of Donofrio Inc. Welcome, John.
Thank you very much for having us today. I know a lot of people have these questions as far as what corporation should we open, how we should proceed. And so I know there was so many questions that people had, and I wanted to basically explain in a little bit more detail here. We're, a company based in New York and New Jersey. We have two offices. We do individuals, businesses, estates, trust, and everything to that nature. But this was one of the topics that I felt a lot of people really needed to understand in a little bit more detail, because look, it's not simple, and seasoned accountants can make, mistakes. And I just want to make sure that everybody's aware of the pitfalls and with setting up these type of corporations.
Thank you so much.
Not a problem. Nick, well, you want to, just take it from here as far as what type of, as far as the situation is opening up the corporation with preparing for it.
Yeah, Nick, tell us a little bit about when's a good time. And Nick is also with Donofrio Inc. and has many years of experience in the accounting world. So we're thrilled to have you as well. When is a good time to decide on how to structure your business?
The most important time is to really plan before starting up anything. You should really talk to a professional. You should talk to somebody, maybe a lawyer and an accountant, and kind of lay out everything that you're intending to do with the business and what your intentions are, what your duration is, and what kind of business it's going to be. Because once you start the company, it's hard to reverse what's been done. So once you start, you're kind of stuck with what you have. And it's a lot more important for different type of entities. Like if you're a real estate rental company owning a building, it'll be much more important to use a limited liability company over a corporation. For service and manufacturing type businesses, it's not as important to choose the LLC. The corporation is kind of maybe a better option for you, but there's pros and cons to all of the entities. But we kind of just want to stress that before you start the business, you really have to make a lot of these decisions right at the beginning.
Well, I'm glad so many people are here with us now, because they can jump right in and get this information. So let's delve in. Can you get started by sharing with us about the two different types of corporations?
So there's obviously a corporation, and then you have a limited liability company. Now, the corporation is a little bit more structured, basically, where pretty much it's the entity itself. You could use Corp, Inc., whatever you like, incorporated. But then the limited liability gives you a lot more options, because there are default mechanisms once you form an LLC, and then there also are elections that can be made based on the type of entity that you need. So let's start off with the first one, where basically you're looking at the entity formation, and the first one is a corporation. Let's just go straight with corporations. You have an S corporation and you have a C corporation. Now, for the C corporation, we'll go the members. Look, they have personal liability they have limited personal liability for the debts of the corporation. Meaning, let's say a vendor, you haven't paid your vendor $20,000, and realistically, you're not going to be able to come up with the money. You don't have the money. That specific is the debt of the business. Unless you personally guaranteed it, that's another story, because once you personally guarantee, you're on the hook because they want to come after you personally. Now, with the limited liability, if there is no personal guarantee, it's very hard, including income tax, for them to collect the money from you personally. However, I want everybody, and I want to emphasize is beware of the trustee taxes when you do set up a corporation. The trustee taxes are payroll and sales tax. Payroll is taken from the employees' checks, and sales tax, you're collecting it on behalf of the state. So those are considered trustee taxes, meaning that even if you claim bankruptcy, even if you try to get, you have this liability and you close the company, they still can come after you personally, because this was never your money, and they want to make sure that they collect it on the payroll and sales tax. So if that's something I could ever emphasize, because it happens to a lot, people sometimes get into a little debt and they say, okay, I'm not going to pay the sales tax, or they have a month that's not good. I'll pay the sales tax next month. Something just stay away from. If I would say right now, and I know if there's any landlords out there, to hold off on your rent first before you pay these payroll taxes, because you have to pay the payroll and sales tax. So I just want to go over the C corporation again. It's tax at the entity level, meaning that it's literally a box, right? The box, you're being taxed inside the box. It does not flow down to you personally, does not go anywhere. However, there is double taxation with a C corporation, and we'll explain how there's double taxation. But I want to emphasize the first thing here with a C corporation, that it is the entity itself considered a different box, and it's taxed at that level. Now, like Nick was saying originally, right? C corporations, they're preferred by, let's say, angel investors. They're preferred by equity partners, because what happens is they're not looking for income stream. These let's say investors, what they're really looking for is make money on the equity itself. So they don't really want, and we call it sometimes tentacles, where you have, a certain company coming down, for one coming this way, one coming that way. They don't want that. They want to make money on the actual entity itself compared to the income. So just to let you know, if you're ever looking to get investors, right, we might want to structure as a C corporation, because that's who's actually going to be looking into it. And a lot of startups are doing C corporations. Then we have, this is an example of the C corporation on the tax, right? Right now, it's universal. It's 21% on the federal tax. We're not sure if it's going to go higher. So on a C corporation, you have $100,000 worth of income. There's 21%. So that means it's $79,000 in the bank account. Now, the question is, do you want to take the $79,000, or do you want to leave it in the business for capital? We could leave it in the business. A lot of people do it. Maybe want to take out a small percentage of it. But, like many other people, we want to live, and we want to, maybe have some fun outside of the business. We want to take the other 79. So now we have 79,000 in profits that can be distributed to the shareholders. It would be a dividend, right? And then the dividend is taxed at the end at the personal rate. So at this point, now we paid 21% on the 100 grand, so it's 21,000. And then if we want to take the entire 79,000 profit, we got to pay another 15% in a dividend to the shareholder, which is double taxation. So it's 21,000 plus the 11,850. Now we're talking 32,000 in tax in order to get that down. Now, we could strategize differently, right? Obviously, what you would want to do is maybe you go back to this equation and say, okay, what about my salary? Do I want to reduce that $100,000 number so my tax is much lower? So, at that point, we could put money into a retirement account. We could take a bonus, whatever it may be. But as you can see right now, we do have double taxation through the C corporations. But there are ways to strategize. I don't want you to say, okay, the double taxation is going to tell me I don't want that corporation, because there's specific reasons why we would want this C corporation. And each individual, we have to go, we have to base their situation on realistically which corporation we're going to file for them. Now, the next one is S corporations. Nick, I'll let you take this one on the S corporations.
Okay, so all corporations, when they're formed, are C corporations, but you can make an election to become an S corporation with your existing C corporation. So once this election is made, the S corporation now becomes what we call a flow-through entity, where John was just showing how if there's $100,000 of taxable income left in the business, there'll be a tax of 21% on that. And then once you pay that $21,000, there's $79,000 left in the corporate account. If this corporation was an S corporation, it's called a flow-through entity because all the income will flow through to the owners and be reported as income on their own personal tax returns. So at the entity level itself, there's zero taxation, but all of the entity's income will go through to the owners on what's called a Schedule K1, and then there'll be zero federal corporate tax, but at 24% using the same $100,000 number, now you have $24,000 in tax, which is less, and you have that money in your pockets. So while you can distribute the $100,000 to yourself to pay the $24,000 in tax, and then you have money left over of $76,000 for yourself. You want to go on vacation, or you could leave it in the business for further, seed capital or what you want to do with it. But the $24,000 in tax, if you looked at this in a bubble compared to the C corporate tax, it's a lot less because you're not paying the tax on the distributed dividends from the C corp. So that's one big advantage for the S corporation that you have to weigh when you're deciding between the C corp and the S corp. Now, like John was saying before, if you're looking to become the next Microsoft or something where you could become a public corporation, the investors don't want you to be an S corporation. They don't want this flow through income and K1, the tentacles John was talking about. So if you're looking to hit a home run and be a publicly traded corporation on the stock exchange, you would want to remain a C corporation. But most smaller companies, they're just looking for the preferred tax benefits of the entity, where if you're a small business and you're not looking to go on the stock exchange, you would probably strongly consider becoming an S corporation with the election, and then you would save tax significantly on the same $100,000 of income we were just talking about.
Nice.
I have a question. Are those taxes that you put forward on the C corporation and the S corporation, are those set taxes? Like, for example, in the C corporation, you had that personal tax rate of 15%, and here you have a 24% tax bracket. Is that dependent on the income, or is that a set amount required as that type of corporation?
Well, the C corporation has the set 21% tax rate. The dividends by statute are also 15% under the Internal Revenue Code. The 24% is this would be the individual brackets. We were just using it as like a most common, the 22 to 28% is the most common range for the clients we're dealing with. But the individual tax at this 24% here could be 15% up to 39% right now. So that one is a graduated tax rate. But the 15% on the dividends and the 21% corporate rate are set in stone, well, at least for this current tax law. It could always be changed by Congress.
Got it. Thank you.
Yeah, and what we did too with the S, we just wanted to try to show you apples to apples, right? So 100,000, if the owner of this one corporation, whether it's C or an S, if he wants his $100,000, and look, I left out state income taxes here for simplicity purposes, but if they have an S corporation or a C corporation, and they didn't make any other money, right? Let's say this husband or wife, the other spouse made $500,000 on top of this $100,000. that 24 is not the tax anymore. They're in a it could be in a 35% bracket, 37% bracket. So on the individual level, it's a progressive system. And with the corporate, it's 21% rate now of flat. And then the dividends, depending, they're also, that's considered investment too. So there could be other tax that was inputted. But I would say right now, just to do apples to apples for the 100 grand, you're looking at 32 compared to 24,000. Now, a lot of other people, before we go on to the limited liability companies, I want to explain to somebody when they have $100,000 of net income. Let's say they don't want to take the 100. They want to actually put 50,000 back into the company. Understand, if they don't spend that 50,000 by the end of the year, December 31st, they still have a $24,000 tax bill on the 100 grand because it's considered a flow through. Flow through does not stop from flowing down to you. Whatever the net income is, the net income. So if you did not spend that extra 50, but you're going to spend the extra 50 the following year, you still owe 24,000 on the business, on tax. However, just know if there's other income in there down the road, if other money's in the bank account, you could take that out without additional tax. Because if you paid 100,000 in income taxes, you damn sure I want my 100,000 of income if I'm going to give you the 24,000. So that's where, it's always yours. You're always entitled to the 100,000. So now we're going to go into something that's a little bit more involved in corporations, because the C Corp, S Corp can be converted. Then you pretty much have, hold on one second. Let's go to the next one. All right. You are sharing. All right. Limited liability companies. Okay. So this is a little bit more involved because, look, you have different ways. You can go from a single member LLC. So a single member LLC is pretty much like a sole proprietorship, right? It's like a Schedule C on your personal return. That's if you do absolutely nothing. Then you have a multi-member LLC, which is the partnership. If you have two or more partners, is the multi-member LLC, which is going to be taxed as a partnership. And then you have an option to do the C Corp and S Corporation, which reverts back to what we just explained for the C and the S Corporation. So the good thing with the limited liability company, right? We still have the limited personal liability for the business debts. That's what we're talking about. And taxes at the entity level, right? There's not many because a lot of it's flow through, but there are certain taxes. And then let's say debt. If there's a debt that you owe to a vendor, right? I mean, if you don't personally guarantee it, then realistically, that's the debt of the business. It's going to be very hard for them to try to get that money from you. But remember, again, beware, and emphasize trustee taxes, the payroll and the sales tax. Those are not our taxes, and they go after those very hard, right? So they go after them because they want their money for something that was never yours. So let's go into the limited liability company with one person. One person is the default method for the limited liability company. It's disregarded. The government doesn't even realize it's an LLC for tax purposes. It's taxed exactly as a sole proprietorship and reported on a personal tax return, Schedule C. So let's look. I'm a W-2 employee. I work for Verizon, and then I have a side job. Let's say I have a side job. I make 30 grand on the side job, right? It's in your name, your social security number. I bought some stuff associated. The net income is 27,000. It's pretty much exactly the same. The Schedule C, sole proprietor, and the single member LLC are one in the same. So that's basically what we would do. The reason why you would not do the sole proprietor, just use your social security name, your number and name, is, first of all, I want to mask my social security with an EIN number. And second of all, I want that limited liability, because at the end of the day, if you're a sole proprietorship and you don't have that LLC, those debts we're talking about to the vendors or something, which I hope never happens, they're going to come after you personally. So we got to be very careful with that. Nick, you want to go on to the next one with the partnership?
Yeah, so now if you have a limited liability company with more than 2 owners, now you have a partnership by default. You can elect out of the partnership with other methods we'll talk about down the road. But, by rule, once there's more than 2 owners, once there's more than 1 owner, you have a partnership. So what this does is it creates the need for a new tax return, where the single member LLC just did the Schedule C and it was a part of their 1040 and their personal taxes. Now, since we have 2 owners, we have to do a 1065. So this is another one of those flow-through entities. A partnership return, the partners, split up the income based upon their ownership percentages, and then they pay the tax on that personally. There could be some minimum taxes on the states, but that's also in the corporate side too. But basically, the flow-through entity, when you're a partnership LLC, will have a K1, and the partners will report all of that income earned by the LLC on their own tax return. So now, this is very similar to an S corporation, where the S corporation also is a flow-through entity, and it gives you the income on your personal taxes, but there's a lot more flexibility with the LLC. The S corporation has been around since the 60s. The LLC came along in like the late 80s, and where the S corporation has to give specific distributions in the ownership percentages, or else you lose your S status, which would be a very disastrous thing for taxes and for everything. You would lose S status and revert back to a C corporation. Limited liability companies allow more flexibility. So one thing to keep in the back of your head when you're planning to start a new business is that LLCs are more flexible than an S corporation at this point in time. But besides that, flexibility on the distributions and things like that, they're very similar in how they operate and how they, how the tax liability comes from those entities.
Perfect. All right, and then after there's other options that we have too, right? We can elect to be treated as a corporation, a C corporation, the original one, right? And then if we wanted to, that C corporation could subsequently, they can elect to be an S corporation. Well, somebody's saying, why would I just not go with the corporation, with the LLC? Because look, the LLC does give us that flexibility, and I'm going to show you how we can revert back if we need to, because there are certain things. Look, structures change all the time, right? And we want to have that flexibility of going back and forth if needed. And with the LLCs, I will tell you, there are a lot better avenues. I mean, it should be the number one entity for real estate in general itself. And I will explain why. So after the elections, there are ways to revert back, like I was saying, right, to single member LLC. So the C corporations are taxed at the entity level, and then you got the S corporation, right? Income flows to the shareholders, similar to the Schedule C, similar to the partnership. Now, what happens if we set up a LLC, single member, first individual, okay, he's doing well, wants to bring on a partner, brings on a partner 50%, right? So now what we do is the LLC goes from the sole proprietorship, it's going to a multi-member. Now you file the Form 1065, which is the partnership. Let's say you make $100,000, both of you split to $50,000. But let's say in year 3, this individual is just not working out. I just don't want to, I don't really want to work with this individual. Okay, he buys him out. So now you're back to a single member LLC. With a corporation, you have no other, you can't do anything else other than keep being a corporation. Here, for simplicity purposes, I can actually mark final on the partnership return and revert back to a Schedule C, a C corp, a Schedule C, which is a sole proprietorship. So now it's basically back taxed to you personally again. And one other thing, they call it phantom income. When you put a real estate, and was the major one years ago, they used to put buildings into C corporations. Now, when you put the building into the C corporation, in order, if you want to just take the building out and give it to somebody else, or you want to do something else, you can't, because it's considered a deemed distribution from a corporation if you take that out, meaning whether you sold it or just transferred the deed, you're going to have to pay tax on it. So at the end of the day, we really don't want to go with that avenue, because look, now I want to, for estate planning purposes, I want to give it to my son, I want to give it to my daughter, but it's in a C corporation. So now if I want to just take it out and give it to him, I got to pay tax. However, the limited liability company, they allow you to carry over the basis. So whatever gains in there, you could literally deed it outside of the property, right, into your personal name, and all you do is carry over. So if there's any embedded gain in there, you would not pay it because it's technically not sold. So there's little intricacies that we want to see that we can get with the actual let's say with the partnership and the LLC than the corporation. So we want to really look at everything when we're trying to figure out what entity you need. And there is one other obviously item here too. S corporations, right? They're not subject to Social Security and Medicare tax. However, Schedule C partnerships, right? They're all subject to Social Security and Medicare tax. Now it's 6.2%. And now if you're an employee, you pay 6.2% and 1.45. You see it on your paycheck every time. However, when you're the owner of it, you have to play the employee and the employer share, because understand your employer is paying 7.65% as you being an employee. So, but here now, as you being the owner, right, you're going to have to pay the other tax. So we got to strategize a little how we don't get, let's say, we don't overpay on the Social Security and Medicare tax. Well, basically, Social Security is capped out at about 147. Medicare, whether you make $1 million or 100,000, they charge you. But the good thing is, if you make 300 grand, you're only going to pay tax on 147 for the 6.2 times 2, the 12.4. But the 2.9, that's forever, no matter what you make. But we could strategize the Social Security, Medicare. But understand, I'm not going in for this specific webinar, but on S corporations, you're supposed to take a reasonable salary. So granted, on the S corporations, the income is not subject to Social Security, Medicare tax, but you do have to take wages, which is before you even get to that point of the net income. We can go over that, maybe in the questions and answers, but it's a little bit more involved. But I just want you to understand, on a Schedule C and a partnership, Social Security, Medicare is taxed on every dollar.
Just one footnote to that, though. If the LLC's income is rental income, that's not subject to self-employment taxes. So if the business in the LLC is a rental, the income on that rental business will not have the Social Security tax. But there was just too many details to go into the slides with that. But just right. One thing to remember.
Yeah, that thing to remember. Nick's right. There's two different things, right? Because you have, one is a passive activity and one is an active activity, right? The active activity is basically your business, right? And the passive activity would be something such as a real estate, which, understand, those two type of incomes have two different laws. They have two different tax laws. So, we would have to go into everything Nick was explaining. But at the end of the day, the LLC, right, that do not select the corporations, they're really good for investments on the rental property. With the LLCs, we limit the double taxation. And the main thing is distribute property from that entity without a taxable event. I mean, please understand how many times, I mean, I've gone through this with clients and like, no, there's just no way we can do it without you having a $250,000 tax balance on the property that you bought 60 years ago, because in Brooklyn, it increased in value. So you got to be very careful on the entities that we select, and before you do anything. So now I guess what we could do is we could take some, Elizabeth, some questions.
It definitely sheds a lot of light on it, but it also shows a lot about how it's important to speak with someone who really is an expert, and who can, because I could see, there are so many different if, ands, and buts, depending upon what your goals are and what your business is.
Exactly.
But let me jump over to some of these questions here. A person wanted to know if they spent the $50,000 in inventory, will they be taxed on only $50,000 in that year? So I think that they're probably talking about that profit.
Right. Okay. So the inventory in itself, right? If you used it, if you use the actual products during the year, yes, but you can get the deduction. But if you actually have it inventory and it was not sold at year end, then you still have that profit. That $50,000, right, is an asset of the business. It's basically the same thing as me saying putting money back into the business. So yes, I do apologize. You still owe that 100,000, but that 50,000 is basically more money that's going to eventually come back to you. So you make more than the 50,000.
Okay, thank you. We have another question. Can you give your children shares of your single person LLC without having to change it into a partnership LLC?
Nick, you want to take that?
No, because once you give it to them or gift it to them, they're their shares, and now you have more than one owner, and by default, you have to do a partnership return. You could plan it where they're, maybe they inherit them, where down the road it would create the need for a partnership, but you still own 100% of those shares or those LLC memberships. But once you get rid of 1% of one piece of the business, now you have two owners, and now you have to do a partnership return.
Okay, thank you. Maria wanted to know, she said, I have one house rental. Which would be the best way to go, LLC or corporation? I think you touched on that a little bit.
Yes, I would definitely say you do a single, if there's only you on there, we do a single member LLC, which is good because look, the single member LLC protects you against the liability itself. And then realistically, in New York State, there's nothing to do other than pay an annual fee for $25, and all you're going to do is report it on your Schedule E on your personal return. So I would go with the LLC. Just know that if anybody's looking to transfer property into an LLC because they want the added protection, please know that the mortgage has to follow the LLC deed, right? So realistically, I know there's brokers out there that would do it, but it's just, you're breaking the covenants of the bank. So realistically, we don't want to transfer a quick deed right into the LLC, and then you got the actual mortgage in their name, in their name. It has to be refinanced into the LLC name. So at the end of the day, the deed is there, but now the bank could call the mortgage because you broke the covenants. You didn't even tell them you were transferring. There are people I've seen do that, and I would ask kindly that you just look into the consequences before doing so.
You could also lose the limited liability protection, as if the mortgage was still in your name personally, you really own the building, not the LLC. So now it's outside of this protection bubble that you wanted to create, because if they looked at the facts, they could, it's something called like piercing the veil, where you really own it since you didn't transfer the mortgage. And now any potential liabilities could be, you could be subject to them.
It leaves holes.
It leaves holes that you don't want, for sure.
No matter how much it may seem to be easy online to set things up, you want to get a professional involved and that you can ask questions too along the way, so that you're getting the best benefit of whatever you select and that you're protected. Can Caitlin has a question. Do LLCs get taxed differently on capital gains and losses?
So with the capital gains and losses is pretty much, it's actually taxed the same way that individuals would go. So if you, let's assume we have, you have your business, 100,000 net income on there, but you put money into into the stock market within your business, and you have some dividends, you have some capital gains or losses. So with partnerships, right, and with single member LLCs, they're taxed a little differently. Each one, it's called separately stated items, right? So you have ordinary income, then you have, if you made dividends, you have dividend income, and then it's actually K1. And if you have capital gains, it would be capital gain income. That's why if you see a flow through a K1, it breaks it down into income, because we want to show, what if you have another active business that lost 20? So now that 100,000 decreases to 80,000. What if you have dividends? Right now, the dividends are capped at 15%. So the rates are based on what the rates are for everybody, the dividends. Same thing with capital gains. It could be 18, it could be 15%, could be 20, depending on your income, but it's still taxed. However, like if you had carryover capital losses and you had a $20,000 gain from your business, you could actually offset it. So that's why they categorize the income, so that it could help you if you have, let's say, other losses, to offset some of these. They do it collectively at year end.
Great. Thank you so much. A question about an entity is what type of entity is recommended for a home-based e-commerce business with subcontractors but no employees?
Nick?
That one, I would probably do the single member LLC, just because it doesn't create another tax return. You still have the bubble of protection from the LLC, just like you set up a corporation, but you don't have to do 2 tax returns. That's what I think would be the best.
And I just want you to, understand too, with the LLC, I'm not going to get too much into New York State and New York City law, but I just want to let you know, with the limited liability companies, right, on the first 100,000 of income, there is no income if you live in the 5 boroughs, right? There's no income on there. But once you go over that, it's 4%. So, it depends on what income we're making as well, right? We got to look into the equation. If you're in Jersey, right, there's no extra New York City taxes, because if you can believe, the corporate tax in New York State, if you're a C or an S corporation, is 8.85%. So you doing business in those 5 boroughs, it's almost 9%. So, but it's 4 for limited liability companies. But we would want to see what your aspirations are for that business. If it's going to be a small one, then we do a single member LLC. And I would probably say with Nick, we start off with the single member LLC, and if you think you're ready to expand, take on people, we decide if we're going to a partnership or we'll go to a corporation, depending on what type of investors you want to. You are basically going to raise money from, if you're going to raise money.
Great. Thank you for that. Joe wanted to clarify, S Corp income doesn't have to pay Social Security or Medicare?
It does. Look, the net income of the S corporation does not pay Social Security and Medicare tax. Understand, government's looking at this because you have to take a reasonable salary on an S corporation. So we were just referring to the net profit of the business, but technically speaking, you have to take a salary. So if you have 100,000 net income, realistically speaking, you really should take perhaps a $50,000 salary, and then the net is 50,000. Now that you're still 100,000 going into your pocket, but you got the $50,000. You got the $50,000 that you'd pay Social Security and Medicare tax on the wages, because it does say by law, S corporations have to take a reasonable salary. I saw a court case with an accountant. He had a 200 net income with a $10,000 salary. All right, that's why we have problems with the Social Security Administration, and they want to see, let's get the S corporation to go down. Let's tax them there and forget the wages. but it's really a two-step question. But just to let you know, on the surface, yes, there's going to be a portion of the S corporation that should pay Social Security and Medicare based on your wages. But there's other benefits to that, because the wages also, the wages are considered income for you to calculate retirement purposes, retirement calculations. So there's more to it, and we can always explain that to you in another conversation.
And the IRS is looking for this now, because say if you have $500,000 of income from the S corporation and you don't take a salary, you're avoiding a lot of Social Security taxes, where this is a big priority for them right now. And I've seen a lot of these cases, most recently, I guess, with these new $80,000 IRS agents out there on the street.
We got our work cut out for us.
Right. Well, I did share your contact info in the chat so people can reach out. Michael wanted to know, can you speak to the publishing requirements for the LLC? Is it easy to do yourself versus using a company like LegalZoom?
Good question. It's, first of all, I think that started in 2006. And aren't we in the digital age right now? I don't even know why. Somebody's making a couple of bucks on that. So look, we normally hire somebody out, because if you do it on the surface, the LegalZoom, I would say one of them's got to be published, I believe. I'm not sure. I will double check this, but one of them has to be published by what New York State says. So, there are companies out there that charge a lot. And if you're in Manhattan, obviously those are expensive, because, it's placing ads in newspapers, which costs money.
As Schneps Media, you can actually go to schnepsmedia.com and you can reach out directly, and someone can help you, placing an ad for an LLC.
Right.
So,
there is a specific registry that different states only accept publication within. That's where the kickbacks are coming in. Somebody's getting a favor by saying you have to use, like, the Albany Law Journal is one of them. It's like weird publications that are only acceptable for these publication purposes.
But just to let you know, we do have an individual that can, we do have a business that we actually associate with for years that can get you a cheaper rate in regards to the publications.
Great, thank you. Another question: if I own an LLC and sell a property, what is the tax difference between owning the real estate personally versus in an LLC when you sell?
Nick, you want me to take
There's
that?
no difference at all, especially on the single member LLC, because there's no other tax return. It's just going on your 1040. But if you do have two partners, and say there's $100,000 capital gain and there's two partners 50-50, those two partners will pay the capital gain, the $50,000 of capital gain income on their personal income taxes. But there's no tax at the LLC level for a partnership. So it goes to the personal taxes, and the single member is already on the personal taxes. So it's all the same tax, basically.
Literally, it's exactly the same tax, like Nick said. And like we said, if it was a partnership, remember those boxes: ordinary income, capital, because, let's say we made money on that real estate, right, and capital gain. And, obviously this year stinks in the stock market. If I have a couple of losses, why can't I offset my real estate? So yes, they do absorb each other. And there is literally no difference on there between if you did it on the personal, whether it was a partnership or a single member LLC.
And about the C corporations, there's every piece of income in a C corporation is at 21%. So if the gain was at the C corporation, it would be 21%. And personally, it'd be between 15, or if you're in the highest tax bracket, 20, but it'll always be lower than 21%.
Okay.
Hopefully.
Yeah. Tyler said, I'm interested in owning a rental property company using properties I own in multiple states. Is it best to open the LLC in my home state or the states of my property? And in addition, I'm looking to turn one of them into an Airbnb. And should I create a separate LLC to rent the space from my rental property income?
So the rental property, so look, there's got to be a for-profit purpose, right? So at the end of the day, you're looking at the management company, and what you're trying to do is, obviously we want to get some expenses for all this work that I'm dealing. Let's say you have 4 properties. I would say each one of the properties you really should have in a single member LLC by itself. And then, with the management company itself, I would say the management company should be where you live, right? If you think you're going to move, perhaps put it into Delaware, because then out of Delaware you could pivot state by state. However, if you're going to be doing all the work here, then I would say just do it in the state that you live in. And the Airbnb, same thing. Put it into an LLC. Make sure the mortgage is in the LLC, the deeds in the LLC. Because look, if you want to do it under one umbrella, maybe you don't want to write more than one check. Who wants to write 30 different checks? If you're going to do the management company, you're going to have all these checks written to the management company, so the management company collects it, and then you report them on your returns. And then within that management company is where, okay, you might want to, you might have meals or something to then, looking at other places, travel, looking at other sites. That's where you'll be able to take the expenses. Otherwise, realistically, if you're okay with collecting the rent for each one of them into their separate entities, I would say just collect them into the rent for into each one of those entities, and then you could break out those various expenses across the various LLCs, or you do that part, the property management. Nick, would you have anything to add on that?
The one thing I would add is we've dealt with some clients that have been dealing with like these different real estate companies, and they've been setting up these LLCs in non-taxable states like Nevada and Florida and Washington State. You would never want to just do that in another state that you're not in, because you're going to be paying, you're going to have to file in that other state, even though they're a non-taxable state. There's no reason to buy a building in New Jersey with a Nevada LLC. So just kind of keep that in the back of your mind, because
yes,
I've seen a lot of people doing that.
Right. Yes. Absolutely. For that, it only should be in the place that you're going to actually have the building. Because look, if we register in Nevada, you still have to register in New York. The property is in New York, so we're going to have to do a foreign LLC. I would rather just do it right from there. It's the building LLC. I mean, even the lawyers, you mention it to the lawyers, they'll say just go strictly with the state that the property is in.
Fantastic. Well, this has been so valuable. I want to thank you both, John, Nick, for being so generous with your information and your time. It's not an easy topic, and there's a lot of intricacies. So I did put your contact information in the chat. I'll also have that. Everyone will get an email tomorrow that'll have a link to this recording, as well as being able to contact John and Nick to be able to discuss further, so that you can get answers specific to your business that you're going to be setting up. So thank you all for joining us today. John, Nick, precious time that you gave us. Thank you. Thank you to all of our attendees for joining some time with us. And please, everyone, stay safe, stay healthy, and I'll look forward to seeing you on a future webinar. Have a great day.
Happy Thanksgiving.
Happy Thanksgiving, everybody.
Bye.
Bye-bye.